Long-term loans, it's all in IFRS 9, which is all about financial assets and liabilities. You're going to come across IFRS 9 a lot more in your future studies. So what do we want to achieve here? After completing this lecture, you should be able to apply the correct accounting treatment of financial liabilities or loans, including the measurement and the disclosure thereof. You must be able to prepare an amortization table, and you must be able to do the split between current and non-current liabilities. Now, the accounting treatment of financial instruments and financial assets and liabilities is largely prescribed by IFRS 9. We are only going to look at the basic treatment of these financial assets and liabilities in this course. Now, what is financial liabilities? Now, financial liabilities is subsequently measured at amortized cost. And we're going to have a look what we mean by amortized cost, and more specifically for financial liabilities. Now, you know that in the statement of financial position under the liability side, we distinguish between non-current, and that is liabilities of which the commitment is to repay that liability in a period longer than 12 months after the financial year end, versus current liabilities, where I have the obligation to settle that liability within 12 months at the longest of the financial year end. Now, these liabilities can both be interest-bearing. Now, typically a long-term loan will have an interest charge associated with that, plus interest-free type of liabilities. If you typically think about your creditors, usually for at least a period of 45 days, they actually provide finance to you when they sell on credit some merchandise to you, and you do not pay interest if in that period of 45 days. Now, these type of loans can also be either secured or unsecured. Now, when is a loan secured? A loan is secured when I actually offer an asset as a security for the outstanding loan. So what does that mean? It means should you not honor the commitment and repay the loan as you have undertaken in the loan agreement, then it means that the person or the entity who has granted the loan has the ability to take the asset, which actually was pledged as security against this loan, sell that asset, and use the proceeds that they're going to get from selling that asset to settle your outstanding debt. Unsecured then means that there is no underlying security, so if you do not pay, they don't have any right to sell any of your assets and to use the proceeds of settling your commitment. Now, interest and payments. Now, interest is paid or calculated as a percentage of the outstanding loan balance as at a certain point of time. So if I receive this loan, initially interest is then going to be calculated on the initial balance. But once I have repaid some of that initial balance, then obviously I cannot pay interest on the initial balance anymore. But I am going to pay interest on the outstanding balance after settlement has taken place of part of the initial balance. Now, capital payments can happen in single amounts at the end of the loan agreement period. It can happen in even capital payments, and it can happen in even payments. Now, these two look very much the same, even capital payments and even payments. Now, even capital payments is, I'm going to grant you a loan of 100,000 Rand. You have to settle that loan by repaying me in 5 equal payments of 20,000 Rand each at the maturity date of the loan on an annual basis. So if I granted you the 100,000 loan on the 1st of January, let's say of 2019, you have to pay the first 20,000 Rand on the 1st of January 2020, and so forth until you have settled the whole 100,000 Rand outstanding capital amount. Obviously, there will be some kind of interest associated with that, and that interest is going to be calculated on whatever the outstanding capital balance was, and for whatever period that outstanding capital balance was for that specific financial period. Now, what is the difference then between even capital payments and even payments? Now, you see that the word that's missing is the word capital. So let's say I'm going to buy a car, a delivery vehicle, and I'm going to take out a hire purchase agreement in order to finance this delivery vehicle. When the bank work out what I have to repay them on a monthly basis, let's say it's 10,000 Rand a month, they will tell me you owe me 10,000 Rand a month. But that 10,000 Rand a month is not only capital repayments, but that 10,000 Rand a month includes capital and interest. So let's say that this hire purchase agreement is over a 5-year period. At the end of the 5 years, by paying your 10,000 Rand or whatever per month, you would have settled not only the outstanding capital amount, which was the purchase price of the delivery vehicle that was financed by the bank, but also you would have settled all the interest on that amount that the bank has borrowed you. So in a case like that, your payment, your installment, in other words, includes capital and interest. Now guys, you're only going to do this split between capital and interest if I state that the repayment includes capital and interest. So if you only have a capital repayment, you're not going to try to split out any interest because there is no interest to split out. It is only where I tell you that the installment or the payment that was made includes capital and interest, and then you're going to do the so-called amortization table where you're going to split the capital and interest from each other. Now, the interest portion obviously is an expense in the statement of profit and loss and other comprehensive income. The capital amount that you've repaid will reduce the balance of the outstanding loan, and the balance of the outstanding loan will be represented in the statement of financial position under liabilities because it is still a liability that I have to honor in the future. Let's take a simple example. Let's say that the initial loan amount that was extended to this entity was 100,000 Rand. And they have to pay an installment or payment of 36,720 Rand per annum, which will include capital and interest. Let's assume hypothetically that the interest rate is 5% or whatever. So the interest then would be 5% of 100,000, which equals 5,000 Rand. So if the total payment or installment that I have to pay is 36,720 Rand and 5,000 Rand equals interest on the outstanding capital amount, then it means that the difference between the two, 31,720, must be a capital repayment. So at the end of year 1, the outstanding loan amount would be the 100,000 less the capital that we have repaid of 31,720, which gives us 68,279 Rand. The year thereafter, we're going to do exactly the same. The only difference is now that the outstanding loan amount is 68,279. Our interest will be 5% of the 68,279, which will be 3,413. The installment stays the same. It is an annual installment of 36,720 Rand. So the difference between the installment amount and the amount included in the installment, which is represented by interest, must be the capital repayment for that year. So what's our outstanding loan amount at the end of year 2? The 68,000 less the capital repayment of 33,306, which will give us 34,972. Then in year 3, we're going to make our last installment of 36,720. Our interest is going to be 5% of our outstanding loan amount of 34,000, which is 1,748. Capital repayment will be the difference between those two, 34,972. And now I can clearly see after this 3-year period, we have settled the total outstanding capital amount. Now, what do we do with interest? In year 1, our interest expense is going to be 5,000 Rand in our statement of profit and loss. What are we going to show at the end of year 1 as liabilities? We said 68,279. However, you know that in our statement of financial position, we have to distinguish between non-current liabilities and current liabilities. Current liabilities are those liabilities which is payable within the next 12 months of the year end. Now, if you think about the 68,000, which portion of the 68,000 is going to be repaid in the next 12 months? And that will be next year's 33,306. That is the capital portion to be repaid within the next 12 months. So therefore, we are going to show under current liabilities short-term portion of the long-term loan, 33,306. And we're going to show under non-current liabilities long-term loan, 68,279 less the short-term portion of 33,306, 34,972. But on the face of the statement of financial position, we're going to show the 34,972 as our non-current liabilities. Let's quickly do another example here. We said that Blockbusters borrowed 122.25 from Standard Bank on 1 January 2012. Annual repayment installments of 40,000 Rand is payable in the next 4 years as from 1 January 2013. The interest rate applicable to the contract is 12.5% per annum. Show the amortization table for the next 4-year period. Good. Now let's quickly have a look at this one. Our outstanding balance as at the beginning of 2013 was 120,225, the amount that we've borrowed on 1 January. Our interest is 12% per annum. So in the 2013 financial year, our interest will be calculated as 12.5% of the outstanding capital amount in the beginning of the year of 120,225, which gives us 15,028. Our total installment is 40,000 Rand per annum. So what is the capital amount that we've repaid? It's the installment amount of 40,000 less the interest amount of 15,000, which gives us our capital repayment of 24,972. So at the end of 2013, what is our outstanding capital amount? And that is our loan amount, and that is our liability in the statement of financial position. And that would be our 122.25 less our capital repayment of 24,972, which gives us then an outstanding balance of 95,253. In the 2014 year, what is going to be our interest? Well, it will be based on our outstanding capital amount in the beginning of the year, 95,253. Closing balance equals opening balance of the next year, times 12.5%, gives us an interest payment of 11,907 Rand. Our installment is still 40,000 Rand per annum. So what was our capital repayment in 2014? It is our installment of 40,000 less the interest amount included in that amount, 11,907, which gives us our capital repayment in 2014 of 28,093. What is our total outstanding commitment at the end of 2014? It is our 95,000 outstanding commitment in the beginning of the year, less the amount that we've settled, capital amount that we've settled, 28,093, which gives us an outstanding capital amount liability in the statement of financial position as 67,160. And that becomes our opening balance in the 2015 year. Interest once more is 12.5% of our opening balance of 67,160, which gives us 8,395. Total installment is still 40,000. So what is going to be our capital repayment? 40,000 less our interest, which is included in the 40,000 of 8,395, which is 31,605. What is our outstanding commitment at the end of the year? 67,160 less 31,605, which gives us 35,555. And now, that is our opening balance in the 2016 year, times 12.5% interest will give us an interest charge of 4,445, which is included in our installment of 40,000, which means in year 4, which is 2016, we're going to repay the remaining amount of 35,555, and at the end of 2016, you can see that everything comes to zero. Now, Our interest expense in our statement of profit and loss and other comprehensive income is going to be 2013, 15,028, 2014, 11,907, 2015, 8395, and 2016, 4445. Let's have a look at our statement of financial position. Our total outstanding loan amount at the end of 2013 is 95,253. What portion of the 95,253 is going to be repaid in the next 12 months? 28,093. So 28,093, which is your capital repayment in the next financial period, is going to be shown as a current liability. And you're going to show it there as the short-term portion of the long-term loan. Now, what is now the long-term portion of the long-term loan? Must be the 95,253 less the 28,093 is going to be the 67,160. So that is going to be the non-current liability, long-term loan, current liability, short-term portion of the long-term loan, total liability 67,160 plus 28,093, which will bring you back to the total commitment at the end of 2013 of 95,253. The same applies to the end of 2014. The end of 2014, the total outstanding commitment was 67,160. But 31,605 Rand is going to be settled within the next 12 months. So that's going to be the current liability, so the short-term portion of the long-term loan, the current liability in the 2015 year, and the non-current liability in the 2015 year is going to be the 35,555. So if you take another example, you say ABC Traders borrows 500,000 Rand from Alpha Bank on 1 January 2015, repayable in 3 annual installments, which include capital and interest of 201,057. The interest rate is 10% per annum. Show the amortization table and the journal entries for 2015. Again, same story, you're going to borrow 500,000. At the end of year 1, this is your installment 201,057. Interest is at 10% per annum, so 10% of 500,000 being 50,000. 201,057 total installment less the interest portion of 50,000 give you the capital portion of 151,057. Outstanding capital at the end of the year, 348,943. Next year, we're going to pay interest of 10% on the outstanding balance of 348,943, 34,894. Total installment stays the same. The difference between the installment amount and the interest amount is the capital repaid in year 2. What is the outstanding loan amount at the end of year 2? 348,943 less 166,163, 182,779. In the last year, I'm going to pay 10% interest on the 182,779, 18,278. The difference between my installment amount and my interest amount equals my capital that I'm going to repay. And clearly you can see that at the end of year 3, everything has been repaid, capital and interest. So our journal entries as at 1 January 2015, we're going to debit bank with the amount of the loan that we've received, 500,000. This is statement of financial position. And we're going to credit the loan that we have received, which is our liability, also in the statement of financial position. Then in year 2015, we have to account for the interest, and there we've worked out the interest. The interest was 50,000 Rand. So at the end of the year, we're going to have interest expense in the statement of profit and loss of 50,000 Rand, and we're going to have interest payable, which is in our statement of financial position, 50,000 Rand, which is the counter leg of that transaction. Then we're going to settle that interest payable by paying them the installment amount. So we're going to debit interest payable of 50,000. There it is. We're going to debit the loan amount of 151,057. You see 151,057, 151,057. And we're going to credit the bank with the installment amount of 201,057, 201,057. Good. Now, what is the definition of a current liability? And we have had this before, and you should be able to know that by heart and to reproduce this definition. Liabilities are classified as current liability if it satisfies the following criteria. It is expected to be settled in the entity's normal operating cycle. It is held primarily for the purpose of trade. It is due to be settled within 12 months after the end of the reporting period. The entity does not have an unconditional right to defer settlement of the liability for at least 12 months after the end of the reporting period. If they had a conditional right to defer it for longer than 12 months, it would not have been a current liability, but then a non-current liability. Current liability, the portion of the loan, capital amount that is repayable within 12 months, must be shown as a current liability, and the rest of that loan will be shown as a non-current liability. So if we're going to look at the presentation in the statement of financial position, proper heading statement of financial position under the equity and liability side, non-current liabilities, financial liabilities 182,780, current liabilities, short-term portion of the long-term loan 166,163. So if you're going to look at this one, the total outstanding amount would have been 703,651 at the end of year 1, and you're going to show as a current liability 3319 and a non-current liability 3717. This one here, total 348,943 is the total liability. Short-term portion 166,163, long-term portion 182,779. And this is the same one that we have here. Then you also have to tell the reader of the financial statements a little bit more about this outstanding commitment. So you're going to say, notes for the year ended 31 December 2013, financial liabilities subsequently measured at amortized cost. The long-term loan, the total outstanding amount as at the end of the year 348,943, less the short-term portion transferred to the current liabilities 166,163, and then you're going to end up here with the long-term portion, the 182,780. There's a short-term portion, there's a long-term portion, but the two of them together will give you the total outstanding loan of 348,943. Then you must also give them a little bit more particulars about the loan. The loan carries interest at 10% per annum and is repayable in annual installments of 201,057. The last installment is payable on 31 December 2015. VAT. Now, the good news is, like you've known by now, that financial services are exempt from VAT, so there's no VAT on interest and loans.